Hi, I'm Brooke Thackeray. Welcome to What's Hot and What's Not for January 2022. Before we take a look at January, let's take a brief look at the price action for the S&P 500 in 2021, as well as the relative performance of the different sectors of the market in 2021 as well. So let's jump right in and take a look. Here's the price action for the S&P 500. Solid year for the S&P 500. You can see here that for most of the year, it was a fairly straight line. Sure, there were a few wiggles along the way, but most months it was quite positive performance. We did see a downturn in September. September was the worst month of the year for the S&P 500. On average, over the long term, S&P 500 tends to be the weakest month of the year for the S&P 500. And then we did see a rally in October, a little consolidation in November and into December. And then we saw that Santa Claus rally, as it is called, where the stock market pushed higher in the last part of December, closing very close to an all-time high. Now, if we take a look at the overall trend line for the S&P 500, here we can see that we're still in an upwards trend for the S&P 500 from a price perspective, which is a positive thing. You can't deny that close to an all-time high is always a good thing. And the low that most people are going to be concerned with is the low that was set for the S&P 500 towards the end of September, just over 4,300. And investors are really going to be watching that level to see if we do go down below that level. And that's a level of support. It might be a little concerning for some investors, which would also be below the 200-day moving average, which is at 4,391 at this time. So investors might be a little bit concerned. But overall, the technical picture from a price perspective is still positive for the S&P 500. Let's take a look at the different sectors of the market. Here you can see the S&P 500 as a reference point, up almost 27%. The big winner of the year was the energy sector. Look at that, up over 50% last year for U.S. energy. Now, it was very volatile along the way, particularly in the first part of the year, and we'll take a look at that in a minute. Real estate was really a sneaky sector that performed quite well. It performed very well in its strong seasonal period from May to October, but even outside of its seasonal period, it still performed quite well. The technology sector, which is closely followed, was up almost 35% last year. Financials also up almost 35% as well. If we take a look at consumer discretionary, almost at market, just a little bit above market. Communication services was a large disappointment for growth investors as the sector just underperformed the other growth alternatives. Industrials was also a little bit of a disappointment, underperforming the market. Materials just slightly outperformed the market. Consumer staples, as you'd expect in a strong year, underperformed the S&P 500. Healthcare was almost at market, and the utility sector underperformed. All the sectors, the major sectors of the market, were positive last year. So there's a little bit of a mix between growth, cyclical, and defensives outperforming at different times of the year and also for the year as well. If we take a look at the growth sectors of the market. So this graph here, this top line, shows the S&P 500. And down here, I'm showing the relative performance of the growth sectors of the market. So the green line here is technology. The blue line is a consumer discretionary. And the red line is a communication services. So when the green line is rising here, that means the technology sector is outperforming the S&P 500. When it's going down, it means it's underperforming. It's interesting to note that the technology sector underperformed in December of 2021. Now, on a seasonal basis, seasonal trend basis, it does have a slow patch that tends to occur from early December into mid-December, and that was true this year as well. Consumer discretionary underperformed and then performed quite well towards the end of the last half of December. And communication services was just a underperformer. Now, for the month of December, it was fairly flat relative to the S&P 500. But overall, the growth sectors really weren't powering the market higher in the last month of the year. We would like to see stronger performance from the growth sectors if the market really is in a risk-on mode. And we didn't see that in the month of December. Now here, what we're doing, so once again, here's the S&P 500. And in this case, we're looking at the cyclical sectors of the market. The green line here is the energy sector. The yellow line is the financial sector. Red line is the material sector. Oops, that's not very good F there. Okay, and that's the material sector here as well. And the last line here, the blue line, is the industrial sector. Look, energy. Look at energy. Look at this relative performance. Strong outperformance in September, coming into October. Now that actually isn't one of the strong seasonal periods for the energy sector. Then underperformance that we saw really take place, and in the month of December, we saw a lot of volatility, and it really was towards the end of the month and into January that we've seen this strong performance from the energy sector. Now, if we take a look at the financial sector, underperformance, and once again, the strong outperformance towards the end of the month. And the red line here is the material sector, really a fairly straightforward performance, and also to the industrial sector, actually performed all right relative to the S&P 500. So the energy sector showed its volatility, really had a good spike towards the end of the year and also into early January as well. And the financial sector had a big tick up as well. Now, what's interesting is if we take a look at in this case, the defensive sectors of the market here relative to the S&P 500. So in this case, this line here, brown, let's call it, is the real estate, U.S. real estate. This blue line here is, so let's go real estate, and this is healthcare. The green line is the consumer staples. Okay, and the red line is the utilities. Look at the performance, strong performance of the real estate sector relative to the S&P 500, really strong. If we take a look at healthcare actually outperformed very volatile, had some ups and downs along the way, but actually outperformed in the month of December. Consumer staples, solid performance in the month of December. These are all relative to the S&P 500. And also utilities outperformed in the month of December as well. So what is this telling us? You typically don't find the defensive sectors underperforming, or I should say outperforming, in the month of December. This is usually when the stocks do well and the stock market does well. This is not the strong seasonal period for most of these defensive sectors as well. So when the defensive sectors are performing, it's telling you something. And in this case, what it's telling us is that investors still want to be invested in the market, but they're starting to get concerned about the valuation of the market. And so they've shifted their assets from other sectors of the market into the defensive sectors. And that doesn't mean the market's going to crash, but it does have a little bit of a concern that we might not see some strong gains coming up in the market in the near future unless we see some really strong catalysts as well, because investors are really starting to get quite conservative overall. If we take a look at what's going on in this case, well, let's just jump right in and take a look in this case at the month of January. We'll come back to, I was showing you the gold there for a second, but let's take a look. This is my Thackeray's 2022 Investors Guide that came out in December. It's got some new strategies, by the way. Microsoft, Verizon, Corning, Valero, Adobe, ADP, and other stocks and sectors of the market as well. So I've tried to add some new stuff in here. And I want to take a look at the month of January, what to expect from an average seasonal basis here. Now, in this case, you can see here that this is the average month for the S&P 500 from 1950 to 2021. Most of the gains are made for the S&P 500 in the first part of the month and also in the last part of the month as well. And that's shown also here's the daily probability of gains, and lines above this going upward are in fact above 50%. So you tend to find the first few days of January tend to be positive for the S&P 500. And there's an overall mix, but you tend to find some strong days towards the end of the month. Now, January is often thought to be one of the better months of the year. On a long-term basis, it is on average. But over the last 10 years, you can see here, I've got these numbers here. We're going to use the S&P 500 here. So I've got myself in the way here a little bit. So the second row here, let's go up and take a look at percent gains. You can see here a solid gain in 2012. And then solid gain again in 2013, then negative 2014, negative in 2015, negative in 2016, positive solid gain in 2018, and 2019, that was after the Powell pivot. And then we saw in 2020 negative, and 2021 it was negative as well. So what's that telling us? In recent years, what we've seen is January's been a pivotal month when the markets actually sometimes reverse direction. So we have to watch that. Even though it's got a track record of strong seasonal performance, doing quite well, we have to watch out that we might see another pivot as well, because the market's done particularly well. Investors might reallocate or go back and take a look at their portfolios, especially if we start to see some of the defensive sectors performing well relative to the S&P 500. That might mean the market might be into a little bit of a pivot. If we take a look here, now this chart here shows you from 1990 to 2021, all the different sectors of the stock market ranked according to the average gain in that time period for the month of January. So the highest gain is at the top. And then over here, we see on the far right-hand side, we see the performance with a frequency of outperformance relative to the S&P 500. And information technology is at the top here, the list in the month of January. A little bit of warning on a caution of that, and the fact that on a seasonal period, the technology sector actually tends to perform very well in the first half of January. Now, in recent years, it's continued on as there really has been a movement towards the growth sectors, including technology. But on average, over the long term, we tend to see the second half of January tends to be a little bit weaker for the technology sector. Consumer discretionary tends to also be high as well. It tends to do well in this time period. The healthcare sector also is one of the better sectors. Look at the industrial sector. The industrial sector only outperforms the S&P 500 31% of the time. Now, there's also a warning on that, and that is the industrial sector tends to perform well in the late part of the year, and also then tends to back off a little bit while the market tends to do some rotation in January, and then starts this next seasonal period around January 23rd. So although this is a fairly weak number here, we could actually see it does start its next strong seasonal period a little bit later in the month. And given the relative performance of what's taking place in the market right now, we might actually see the industrial sector actually outperform even in most of January as well. Financials tends to perform okay. Utilities tends to be an underperformer relative to the market. That's going to be largely dependent upon what's happening with investor appetite and interest rates. Energy. Now, I wanted to point out energy here. Energy is performed quite well in the last few days of December, and also too in the beginning of January. Now, in January, it tends to have an average performance. This is from 1990 to 2021. Here's the energy sector. Average performance negative, and also as well, it only has outperformed the S&P 500 41% time. Next strong seasonal period for the energy sector starts on February 25th. However, when you've seen weak performance in the fourth quarter or the last part of the year, you tend to also find that it can present a good opportunity to get into the sector early before the start of its seasonal period. Now, just as an example, I'm going to skip across over here to show you this chart. This is the performance in January 2021, and here's the energy sector. Look at this strong performance in the first half of the month. This shows you how volatile the energy sector was last year. Up almost 18%, and then we saw this underperformance for the energy sector in the second half of the month in 2021, January as well. So we might see a good entry opportunity early this year, which is possible, but we tend to see some volatility. In fact, if I flip ahead here, I'm just going to flip ahead to show you the energy sector here, and I'll go back. Here's the energy sector, the median performance. In this case, we're using XOI, the NYSE Arca Oil Index, XOI, oil and gas stocks. Look at the performance here. The median for the energy sector in the month of January, in this case, is from 1984, is negative 1.5%, and it's been positive almost half the time, which is not a really high number actually overall relative to what if you look at some of the other months from a seasonal perspective. And also too, February tends not to be that strong, but it's really towards the end of February on average you tend to find a pickup. But nevertheless, it could present an opportunity in January, but on average for the full month of January we tend to see a little bit weaker as well. If we go down and take a look, you can take a look here. The material sector tends to be an underperformer, very much like the industrial sector. Later on in the month, it starts the seasonal period. Also, too, as well, given what's happening here, the market's really trying to figure out if the cyclical sectors are going to sort of pick up the slack here a little bit. We could actually see the material sector actually start doing better earlier in the before the start of its seasonal period, which starts later in January. Telecom tends to underperform here, and consumer staples tend to underperform. So when consumer, and also be negative on average from 1990. So if we see consumer staples actually outperform in the month of January coming up, that would actually mean that the market's actually becoming quite defensive overall, and there might be it's more muted gains ahead overall for the market. The semiconductors tends to perform well. Home builders, which has really performed very well actually, it tends to be one of the top subsectors of the market. These are just selected subsectors, so it's not a full index here as far as that goes. But the word of caution for the home builders is that it ends its seasonal period in early February. And particularly if you see interest rates heading higher in February, that could be an indication actually to be getting out. Silver, gold, this is one of the better months for silver and gold as well. Retail, I want to point out retail as well. Look, it's down the list here, but this is for the full month of January. The retail sector tends to pick up towards the end of January. In fact, the strong seasonal period is from January 21st until approximately April 23rd as well. So it tends to be a strong seasonal period for retail. That's going to be a hard one to judge. There's a lot of stuff going on in this sector right now. So lots of stuff going on. Metals and mining, chemical. Look at the chemicals. It tends to not perform well. In fact, last year it actually performed poorly. It was down 2.6%. Now, when I point up here, just to let you know, the material sector, by the way, this is U.S. material sector. Depending on how you look at the sector, but it's often classified with approximately 70% chemical companies. So we might see a little bit of a slack for the material sector in early January, but later in January, it really tends to pick up as well, something to watch out for as well. I want to point out that a couple things right now as well is that a couple sectors you want to take a look at from a market perspective to help gauge a sentiment. And so here's the small cap sector. We're using, in this case, we're using IWM, the ETF to represent the Russell 2000. Look at this performance. This is an absolute basis, okay? So really fairly bad. Came down to this line here, bounced off support, went up, bounced off support, and really had this consolidation box, okay? We did see that breakout that occurred back in November above this box. And I can tell you, we saw the small caps just all of a sudden shoot up as traders were really focused on this line here, this level of resistance. And when it broke above that, we saw that all of a sudden the small caps jump up, and then it came back down again into the box. Small caps are actually in this strong seasonal period, which starts in mid-December and runs into early March. But we really haven't seen strong performance. So this line going all the way across here, this consolidation box, if you think about it, with the S&P 500 up almost 27%, that means that the small caps have really performed poorly. Now, that was after a huge uptake in 2020 at the end of the year. Oh, and guess what? It finished its strong run relative to the S&P 500 right at the end of a strong seasonal period in early March. So we've seen this underperformance for the small caps relative to the S&P 500. That partly means that in this case here, because we are in the strong seasonal period for the small cap sector when it tends to do well, that there's not a huge risk appetite going on. You'd expect the small caps with a high risk appetite in its strong seasonal period to actually perform well, and that's not what we're seeing. I've also put down here this graph here. So this line up here was from the small caps relative to the S&P 500. This line down here is the growth sector relative to the value sector. And if you take a look, growth did extremely well in 2020 relative to the value sector, and we did see that pull back. And then growth has been outperforming. So why am I showing you growth versus value? If you take a look at the two lines here, just because of the constituents of the small cap sector, it tends to perform better when the value sector is outperforming. And that has not been the case. Value, if you take a look, value growth has been outperforming here. And what we've seen is really the small cap sector underperforming. And there are other factors that help the small cap sector outperform, such as a stronger U.S. dollar, because of the companies that are small cap tends to be more domestically generate the revenues domestically. But in the last couple of years, it really has been tracking some of the value versus growth. And I got to say that, people are really wondering, is value going to overtake this year finally? And because investors are really focusing on growth stocks and sectors of the market, and the technology sector and the consumer discretionary sector, and that's really has been their focus. And value investors have just been, pummeled over the last few years as they expect, intrinsic value to take place, a rotation into that. And I'm going to write more about that in my upcoming newsletter as well, which I'll put out next week. So where do we stand in the market for January 2022? Well, first of all, we have come off a fantastic 2021 for the stock markets. The S&P 500 was almost up 27%, which is a huge gain. Now, a lot of investors may say, well, after such a large gain, that the market will be an underperformer in 2022. It's not necessarily the case at all. There's no correlation between a large performance in one year and the direction of the stock market in the following year. A lot of investors are concerned about some of the higher valuations in the markets, such as the PE ratios. But that was true back in 2019, 2020, 2021. Looking at some of the valuation metrics is very difficult to make a timing decision or a sentiment decision as well, because the market can remain highly valued for an extended period of time. So where should investors be looking? I believe investors should be looking right now at the relative performance of the defensive sectors compared to the S&P 500. This is particularly pertinent this year because in December we saw the defensive sectors outperform the S&P 500. Now, typically that does not happen in the month of December. So what that's showing is that investors want to be invested in the stock market, but they want to position more defensively. If we see the same trend take place in January, that could mean that we're in for more muted gains in the future. So it doesn't mean the stock market's going to crash, you're correct. It just means that investors are positioning themselves more defensively. So maybe the gains might not be as large. Also, too, we tend to find that when the defensive sectors are outperforming at this time of year, the market tends to narrow its breadth, and it already is extremely narrow. So outside of the defensive sectors, you may see a few stocks or a few sectors really driving the market otherwise as well. But overall, this often is a time for caution. We're still in a strong 6-month period for stocks as well. There are some opportunities from a seasonal basis for the market in January. Gold tends to perform well in January. Silver tends to perform well in January. Gold miners tend to perform well in January as well. You tend to find the energy sector could put a bottom in January. Start a seasonal period early. It starts usually in February. You find some of the cyclical sectors starting to improve their performance later in the month. The retail sector tends to start at a strong seasonal period later in the month. Lots of stuff going on in that sector, so it's a little hard to determine on that one. So there's a lot of rotation in January, a lot of opportunities. So January really is a month to look at and say where are investors positioning their portfolios, and the market tends to settle down towards the end of January, and more of the seasonal patterns and opportunities tend to kick in at that time. Something to watch out for in the month of January. Thank you very much for joining me today.